Howdy, everybody. Welcome to Liberty Call. Today is Friday, November 22nd, 2024. Hope you're having a fantastical day out there in the interwebs. Pretty nice day here in Colorado. It's been kind of cloudy, but the sun has creeped out a little bit. So hopefully we'll have a decent weekend here, and hopefully wherever you're at in the world, the weekend will be nice too. So, all right. Looks like the markets, for the most part, were in a decent mood here, at least domestically and in Europe. So before we jump into the numbers, where am I pointing at? Right there. There's the camera. If you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. Now we can get into the markets. All right. Dow Jones was up 0.97%, 426 points, closed at 44,296. S&P 500 up 0.35%, 20 points, closed at 59.69. NASDAQ up 0.15%, 29 points, closed at 19,001. The VIX fell 9.54% today. It's at 1526. Canada was up 0.21%, Brazil up 1.74%, and Mexico up 0.52%. All right, let's head over to Europe. Germany was up 0.92%, the UK up 1.38%, France up 0.58%, the Netherlands up 1.58%, Spain up 0.39%, Italy up 0.6%, Switzerland up 1.14%, and Portugal up 0.76%. Russian exchanges split today. The MOEX was up 0.47%, the RTSI down 1.39%. And the Asian markets, Nikkei in Japan was up 0.84%, Australia up 0.85%, New Zealand up 1.63%. In China, they were not so good. Shanghai was down 3.06%, the Shenzhen Component down 3.52%, China A50 down 2.72%, DJ Shanghai down 3.16%, Hang Seng down 1.89%, and the Taiwan weighted was up 1.55%. All righty, good stuff. Let's jump into the markets for the week and see how they did. All right, let's find that candlestick from last Friday. Starting out with the Dow Jones. Looks like we're going to finish up in the green, up 1.87%. The S&P 500, looks like it's going to be up about 1.57. The NASDAQ, up about 1.77. The Dow Utilities going to be up about 3.08%, and the Dow Transports up about 0.71, 0.82. So looks like that one's the laggard of the five major indexes that are the default here on my charts. So all right, so not a terrible week all in all. So if we zoom out, we can kind of see what things have done here in recent weeks. This last trend, we had been bouncing off of it here. This is the Dow Jones. Since the beginning of August, we'd been in this uptrend, bounced off the trend line a few times, broke through around about a month ago and traded sideways. And then after the election, jumped. Looks like it was going to, come back within this, above the trend line again, but it has not. So looks like it's lost some of that upward momentum, and we'll see. Is this going to trade sideways or what? So let's go over to the S&P 500. Again, a very similar chart. Bounce, 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 and broke through, went back above, and now we're just kind of waiting to see what the trend is starting to line up as. NASDAQ looks almost exactly the same. So, all right. So those are our markets and charts for the week. Feel smarter? I know I do. All right, let's get into the data that came out this week. Starting out with jobless claims. Initial claims came in at 213,000. Forecast was 220. Previous number 219. Continuing claims came in at 1.908 million. Forecast was 1.87 million. Previous number was 1.872. The National Association of Home Builders Housing Market Index came in at 46, above the forecast of 42. Previous number was a 43. And I believe, anything above 50 shows growth in the home sector, and anything below 50 shows a negative outlook. So, U.S. housing starts grew at 1.311 million. Forecast was 1.34, so a smidge above below the forecast. Previous number was 1.353. And on a month-on-month number, housing starts receded by 3.1%. The previous number was a contraction of 1.9. Building permits currently are sitting at 1.416 million. The forecast was 1.44, Again, about 24,000 below forecast. Previous number was 1.425, and on a month-on-month number, it contracted by 0.6%. Previous number was a contraction of 3.1, so a little bit of an improvement there. Existing home sales, we have a number of 3.96 million, smidge over the forecast of 3.95, and the previous number was 3.83. And on month-on-month number, existing home sales grew by 3.4%. Last month, contracted by 1.3. And last but not least, the Michigan consumer sentiment came in at 71.8. Forecast was 73.7. Previous number was 70.5. So it looks like it went up, but but it didn't hit the forecast. So not great there. All right. Well, that is all the economic data we can stomach for the week. Let's jump into the market recap so we can head towards our weekend. All right, Dow rides rotation into cyclicals to close at record high. All right, the Dow surged to a record high on Friday, bolstered by rotation into cyclical stocks, particularly industrials, as tech continued to underperform. Boeing led industrials with a 4% gain after securing a $2.39 billion contract modification from the Department of Defense, so basically a loan from the government. Optimism about cyclical stocks was further fueled by expectations of U.S. economic resilience under a potential second Trump administration. Economic data pointed to a healthy U.S. economy, really. The S&P manufacturing PMI rose slightly to 48.8 in November, while the services PMI jumped to 57 from 55 in October. Strong economic signals and October's robust inflation data cast doubt on December's rate cut by the Federal Reserve, with traders pricing in a 61.7% chance of a 25 basis point cut. Hey, the Amazon guys here. In Europe, economic news disappointed as the Eurozone's business activity deteriorated sharply, with services contracting and manufacturing plunging deeper into recession. Tech stocks struggled as regulatory pressures weighed on major players. Alphabet dropped over 1% following the Department of Justice's push for the company to sell its Chrome browser and potentially share data and sell its Android operating system to curb monopolistic practices. Nvidia fell 3%, reversing prior gains as it warned of slower revenue growth despite strong AI-driven earnings. In contrast, Gap soared nearly 13% on strong holiday sales. Holiday sales? It's not even Black Friday's next week. And raised annual forecast, while Intuit tumbled 5.7% after issuing weak guidance for the upcoming fiscal year. The rotation into cyclical stocks, regulatory scrutiny on tech, and mixed economic data highlight ongoing market dynamics, with industrials leading the charge amid a backdrop of cautious optimism. Good stuff. All right. Let's jump into our next article here. Comes from Zero Hedge. Trumpflation risks likely overstated. Are you telling me that the leftist media or the leftist corporate media is being hyperbolic about Trump? No way. I mean, it's funny. These people are having a heart attack about folks like Pete Hegseth, who is a nominee for Department of Defense or Defense Secretary. And I mean, granted, he was a colonel. I mean, certainly much higher than petty officer third class that I was. I mean, granted, I think I could run the Department of Defense just as good as anybody. But it's like, oh, these people are not qualified. Blah blah blah. It's like you had a man in a dress handling nuclear stuff. I mean, seriously, it cracks me up. All right, let's get to the next article here. All right. Concerns around Trumpflation, inflation driven by fiscal and trade policies under President Donald Trump, have resurfaced as he begins his second term. While fears of rising prices and interest rates dominate economic discussions, evidence suggests inflation may not surge as dramatically as predicted. Economists argue that tax cuts, increased military spending, and tariffs could spur inflation by boosting economic demand and restricting imports. Well, let me stop here. Well, if we cut, slash, and burn the federal budget by, half, and fire 3/4 of the federal workforce and get them being productive in a real job, I don't see this as being a real problem. I mean, if you cut all the spending at the federal level, then we can reduce taxes, still have a way to pay off the national or the federal debt in, probably take 30 years at this point granted, because we don't want inflation anymore, because that's always been their plan. inflate the currency, inflate the economy so that the debt, while it seems huge right now, will be small. But the problem is they keep adding to the debt every single year instead of just leaving it at, when I ran these numbers the first time when I was, probably 2008, 2009, the federal debt was, under 10 trillion. And it was going to take 10, 15 years at everyone paying, 25% taxes and slashing in, the federal spending. But anyways, so like I said, the hyperventilating about, oh my God, we're going to have to pay too much in tax. It's just, it's craziness. Where are we? Historical concerns about tariffs, raising domestic prices, and escalating government deficits have added fuel to these fears. However, a look back at Trump's first term offers context. Despite similar policies, inflation and interest rates remained around 2% until the pandemic disrupted the global economy. Key economic headwinds challenge the Trumpflation narrative. Number one, easing supply chain pressures. Post-pandemic supply chain normalization has reduced production costs, easing price pressures on goods. Stabilizing energy prices. Oil production increases have tempered energy costs, mitigating inflationary pressures on transportation and manufacturing. Shifts in consumer spending. Consumers are spending less on goods and more on services, which have a lower multiple effect on economic growth. And slower global growth. A cooling global economy is reducing demand for raw materials, lowering import costs and easing inflation. Also, massive debt and slowing productivity remain structural barriers to economic growth, favoring deflation over inflation. Historic parallels, such as Japan's stagnant growth, despite high levels of debt, reinforce this perspective. So in conclusion, while fears of Trumpflation persist, key dynamics ranging from global economic trends to domestic productivity indicate limited inflation risks. Stabilizing energy prices, easing supply chains, and consumer behavior shifts suggest a more balanced economic outlook, making runaway inflation unlikely. As the second Trump administration begins, focus will likely begin on managing growth and amid persistent economic challenges. Yeah, and like I said, it's all these people hyperventilating about the folks that Trump is picking. It is quite humorous because again, this person has never, people like, oh, well, they've never done that. It's like, well, Mayorkas, who's the HHS secretary, just an attorney and a politician. I could go through the entire Biden administration, and most of these people were just, DEI hires who, depending upon how many, mental problems they had or how many boxes they checked off. Oh, you got 3? All right. Well, we're going to put you as press secretary. All right. Perfect. Anyways. All right, let's get to the last article here from the Mises Institute. Distress in commercial real estate bonds hits an all-time high. So while, the economy seems to be okay, I think commercial real estate is in some real trouble just because, people aren't working in offices nearly as much anymore. All right. The commercial real estate sector faces mounting challenges despite the Federal Reserve's recent 50 basis point rate cut in September. Commercial real estate and CLO bonds, which package short-term floating rate loans used for property financing, are showing record levels of distress as high rates and declining property performance expose vulnerabilities. Bridge loans issued during the 2020 to 2022 era, when rates were near zero and real estate prices peaked, are now maturing in a much less favorable environment. By Q3 of this year, the distress rate for commercial real estate and CLO loans hit an all-time high of 13.1%, with apartments at 16.4% and office spaces at nearly 20%, most affected. Retail properties also remain under pressure due to post-pandemic structural changes. Worse still, data from the MSCI reveals that potentially distressed apartment loans amount to about $81 billion, suggesting that nearly 95% of all apartment bridge loans are either currently distressed or at high risk. Interest rate hikes, stagnant net operating incomes, and rising costs for taxes and insurance compound the financial strain. The floating rate nature of bridge loans has been devastating as rates surged from near zero to current levels. Loans that once carried a 3.5% interest rate now face rates exceeding 8%, doubling interest costs without corresponding revenue growth. Hopes for refinancing depend on the fixed rate agency market, which relies on lower treasury yields. However, bond markets remain stubbornly resistant, with the 10-year treasury yields climbing back to pre-rate cut levels of 4.3%. Despite the past reliance on Federal Reserve bailouts, the expected magic bullet of rate cuts has yet to materialize meaningfully. Consumer real estate lenders now face a stark reality. Without sustained monetary easing or quantitative easing, they must reckon with deteriorating fundamentals and limited refinancing options. The sector's struggles underscore the broader economic tensions in a high-rate post-pandemic landscape. Again, these rates are not really that high. I mean, in the grand scheme of things, these are medium. If they were in the teens, that would be high. Even maybe pushing 9 or 10%, I would say you could start bitching and moaning. But 7, I mean, really, that's what car loans were back in the 90s and early 2000s. I mean, that's homes were 6, 6.5, depending upon what the given rate was at the time. So. Anyways, all right. Well, that's all the information I wanted to share with you today. So if you need anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. Or an email. Either one's fine. And I'd be happy to help. All right. Well, like I said, that's everything that I had for today. Hope everyone has a terrifical weekend, and I'll talk to you all next time. Adios.